Hello everyone and welcome back. In this video we are going to talk about Fortinet because the company just reported earnings the fourth quarter of 2025 and the stock is for the moment up 2%. You have a stock price up in pre-market 2%. When the company reported earnings, the stock went up 10% and then up 5%, 4%, 3%, 2%. Okay, so what is happening with this report? Why is the hype fading away? Maybe you will watch this video, the stock will be down, maybe rebounding. In this video, I want to talk about the numbers, the real core operations of the business. So here is the plan for this video. This video will be long because this video will be complete. And I believe this is the only video you need to watch to really understand Fortinet and what is happening with this report. So, in this video, I want to go through the earnings report. I have some comments to make, okay, things that I have highlighted to really understand what is happening with the report. We will also go through the slides, the investor presentation of the report. And yeah, I have some comments to make also. We will go through my Google Sheet. I did some analysis. I analyzed some numbers. I will show you some charts that you have not seen before. And also together we will listen to the earnings call and I will react to this. I did not listen to the earnings call yet. Yeah, this will be the plan for today's video, and I will tell you if I buy more, if I want to sell the position, because full disclosure here, I'm a shareholder of Fortinet, and this is approximately 10% of my portfolio. So it's a core holding, a core position, and one of my best convictions for 2026. I think this is a very well-run business, extraordinary business, and I think the stock is now at fair value, fair price. Okay, so a wonderful opportunity. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And this is not the first time I am buying Fortinet. I first bought some shares a couple of years ago in late 2020 and made a quick triple out of the stock because I've been following the stock for a while, and I sold because of valuation concerns. And I was waiting and waiting and waiting and waiting, and when the stock dropped in summer 2025, I opened the position. And when the stock dropped again in fall 2025, I doubled down. Okay, so of course I'm monitoring what is happening with Fortinet. It's a very, very good business in the cybersecurity industry. So very interesting. So let's start with the report because this will be very interesting for you. I have highlighted some things in this report, some elements that show reacceleration. And by the way, just for this video, I recorded the preparation, how I prepare for these videos, the behind the scenes. I believe it should be available for members of this YouTube channel. So in case you want to support this channel, you can become a member and you have access to these exclusive videos, okay? But now let me start and let's enjoy the show. So, fourth quarter of 2025, the revenue grew 15% year on year, which is really good for Fortinet. Let me start by saying Wall Street thinks that Fortinet will slow down. The guidance, what Wall Street thinks of Fortinet is the company will grow earnings at 11% per year, will grow revenue at 11% per year. And now the management is saying we are growing 15% per year, more than what Wall Street thinks, which is pretty good. The product revenue grew 20% year on year. You have a reacceleration. The billings grew 18%. You have a reacceleration. The unified SASE billings grew 40%. Okay, I have some comments to make and I will navigate through Fiscal AI to show you the graphs, to show you the reacceleration. I can show you the percentage change of revenue. As you can see here on a quarterly basis, you are reaccelerating. For Fortinet, you have hardware, so products, and software, the services, the two segments here. For the, look at this, product line in red, it is reaccelerating, and the product, the hardware segment, is now growing 20%. a few months ago, we didn't have this. We had deceleration. And for the services, for software, we are continuing to slow down. But you have a lag between these two indicators. Anyway, I will talk about this later on this video. Next, you have the billings that grew 18%, and I put this in green because I think this is very positive. The same way you want the revenue for hardware to reaccelerate, you want the billings to accelerate. And the billings are up 18%. Billings can be attributed to an equivalent of a backlog, like future revenue, what is contracted for clients. And as you can see here, the billings were going down, decelerating in 2023, kind of slow in 2024, and in 2025 it went from 10% to 15% to now 18%. Billings are reaccelerating. Revenue growth for products is reaccelerating. The business is reaccelerating. And Wall Street, if you click on estimates, you can see what Wall Street thinks. Wall Street thinks that the revenue will grow 11% per year in 2026 and 11% in 2027. The business is reaccelerating and Wall Street is very conservative. Next on the list, you have the full year highlights, what Fortinet achieved for the full year of 2025. The revenue grew 14%, so more than Wall Street thinks. Product is growing 16%, billings 16%, unified SASE and billings grew 24%. For Fortinet, you have a few parts. I told you about hardware and software. What I want to say is the software part for the billings is growing a lot. And I will show you what I mean later in this video. I have some specific pie charts to show you. But what will drive the growth in the future will be software. And the billings, the demand is reaccelerating right now, which is really bullish. They generated a free cash flow of $2 billion. So in the cybersecurity industry, this is one of the few companies that is profitable and is generating free cash flow. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Now, what is the management saying for this quarter? So far, we are seeing good results, reacceleration and profitability. So pretty good, right? We are pleased with our strong finish to the year, highlighted by an excellent fourth quarter, driven by broad-based demand across our portfolio, which drove billings above the high end of our guidance. What they are saying is they guided for specific numbers and they did more than the expectations. We continue to execute our strategy by accelerating our investment in high-growth unified SASE and SecOps markets, delivering strong momentum while further strengthening our secure networking leadership. As the number one firewall leader with a 50% unit market share, Fortinet is well positioned to extend that leadership into SASE, driven by our rapidly expanding SASE adoption and growing customer demand. Our easy-to-adopt FortiSASE solution, blah, 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 we are supporting and helping a lot of people despite the competition. They are the leaders in the hardware market, and they are reaccelerating across different business lines. Now the business is highlighting a few business features. The first of which is the company recently announced an integrated solution with NVIDIA that delivers isolated infrastructure acceleration for the AI factory. So embedded something to provide firewalling, segmentation, policy enforcement directly in the infrastructure for higher performance, stronger isolation, and simpler operations. Question for the call, this is my comment. How long is the partnership? Is this a 2-year partnership, 10 years partnership? How big is the commitment? Do you have any guidance on future revenues coming from this partnership? And any numbers would be lovely to know, because they recently announced a partnership with NVIDIA to give them some firewall equipment, hardware equipment. How big is the partnership? How long is the partnership? The management is not providing any data, so it is bullish, but how bullish it is? Next bullet point, recognized as a Gartner choice. I don't care about this, not important. They won a prize from Google, not important. And they won a prize for this one, an award, not important. Also, they forgot to mention something from December 2025 because there was another announcement. You had two announcements for the past 3 months. One with NVIDIA, two with Arista Networks. Let me quote. Fortinet and Arista Networks joined a joint secure AI data center solution combining ultra-low latency networking with ASIC accelerated security, so their own custom chips, to deliver a scalable zero-trust AI data center blueprint already deployed at monolithic power systems. I would love them to have included this, and they forgot to mention this. So a few questions. Maybe the deal with Arista Networks has died. Maybe the deal with Arista Networks is not important. Maybe the deal completely failed. Maybe they postponed the deal until 2026. Or maybe they want to hide some stuff. A lot of questions. Why did they forget to mention this? Next point on the earnings report, something really bullish, and I believe this is maybe the reason why people got so enthusiastic, so optimistic about the stock when they delivered earnings, is Fortinet increased their buyback authorization by $1 billion. Okay? And they also said something pretty important. As of February 4th, approximately $1.4 billion remained available under the share repurchase program, including the $1 billion increase. In the past quarter, in Q3 2025, you can go back to the report, and they said that $800 million was still available for buyback program. Now, if you expand $800 million by $1 billion, the buyback program should be 1.8. But what they're telling us right now is you have 1.4. So you have a delta, 1.8, 1.4. So they did roughly $400 million of buybacks in the past few months. I expected more. Stay with me because there is a nuance here. Actually, the company did not do a lot of buybacks this quarter. I can spoil you the fun a little bit actually, because I already did the work. You can go to the cash flow statement and check this line. Oh no, you know what? It's on an annual basis. So I can show you on Fiscal AI the amount of buybacks that the company did during 2025 fourth quarter. Look at this. Buybacks on an annual basis. Let me show on a quarterly basis. Last quarter, they did $2 billion of buybacks, like $1.8 billion of buybacks. And now this quarter, Q4, they only did $50 million of buybacks. At the same time, the stock price was the same. So actually, I am quite disappointed to see such a low buyback quarter. Given, 1 quarter ago, the stock was low, you did a strong buyback, so you think you are cheap. The stock price stays the same, and you are no longer doing buybacks. What is happening there? So big question here. And now, if you are following what I just said, you should have a question. You should say, Chris, didn't you say that they did $400 million of buybacks? This line. So where is the $400 million? Did they do $400 million or $50 million? And it is a great question. I'm glad you asked. Actually, the management is sharing some information, and I can already cross-check what is happening with the slides, because the fourth quarter of 2025, so the report we are analyzing right now, is between October 2025 and December 2025. Okay? But actually, they did a tiny buyback during this period, and they did the remaining, they did $400 million of buybacks. $50 million was done during October and December 2025. What about the remaining $350 million of buybacks? Actually, on the slides, we have additional information. Look at this, at the right of the screen. You have a buyback program that was already started in 2026. So for the first quarter quarter of 2026. They did $350 million, which is quite surprising to me. Why do you do a buyback in Q1 for next year and you don't do any buybacks for the fourth quarter of 2025? The stock price was the same. Look at the stock price over time. No meaningful change, right? But seems like, what was the stock price in October? In October, the stock price was 85, and in December, 80. Okay. And in 2026, the stock price dropped, and they already did a buyback program of $350 million. And the quarter has not ended. So maybe if the stock price stays low, it's quite likely they continue the buyback program. Okay, you now understand why you have a gap of $400 million. Oh, but in reality, they did $50 million during this quarter. You now understand the mathematical gymnastic behind this. And that's it for the quarter. They announced a guidance, which is really interesting to follow. For the guidance, I already did the work, so you don't have to. This is something you can watch on the other video I published, only exclusive to members of these channels, how I am doing this work, etc. You have all the exclusivity of the information. And the revenue for 2026 is expected to grow at 12% per year. The service revenue, so software, is expected to grow at 11% per year. The billings expected to grow at 13% per year. What is really surprising to me is they have grown total revenue by 14% in 2025. The product revenue has reaccelerated at 16% in 2025. The billings are at 80%. Now the revenue for product is up 20%, but they still guide for 12% total revenue growth rate in 2026. I think the management is being very conservative. The business is reaccelerating, but they don't put the reacceleration in their guidance, as if the revenue will reaccelerate and then slow down again. I don't think this is what is going to happen. So I think the management is being very conservative. And to understand this, you have to understand what happened to Fortinet in 2023. In 2023, during Q3 and Q4, back to back, the company lowered their guidance and the stock price was killed by Wall Street. Since 2023 and this disappointment, the company has always been very conservative for their guidance. I think for 2026, they are also being very conservative. They say, we are reaccelerating, but the guidance is low. You have to choose. Either you are reaccelerating or you are slowing down. So it doesn't make sense for me. I'm seeing some strange things here. Also, what do they say about the guidance for 2026? They expect a tax rate of 18%, so supposed to be roughly stable. And also they say something quite interesting. They say they have a guidance for EPS, earnings per share, and assuming a diluted share count of 747 million shares to 753 million shares. Now it will be a little bit technical, stay with me. The number of shares at the end of this report in December 2025 is 748. You can show this, you can see this at the end of the income statement. This line, boom, 748, okay? And they have already repurchased 4.6 million shares in 2026, the equivalent of $300 million. That I just showed you the slides just before. Look at this, just this line. They have already repurchased 4.6 million shares. So now, as we are speaking, the real, we are in February, right? The real number of shares is $744 million of shares. And they don't put the buybacks on their guidance. Here, for their guidance for 2026, they assume a stable share count, but we already have the data. The share count has already declined. This is also very conservative. So the management just issued the guidance for 2026. For the growth rates, I think they are being conservative. For the number of shares, I think they are being conservative. So for the revenue, I think they were conservative and they will beat estimates. And for the earnings per share also, they are being very conservative. I think they will beat estimates. Keep in mind that they already did $300 million of buybacks in January. Only January, right? I'm recording this video February 6th. So only January. February has not ended. And they just announced a new buyback program of $1 billion. And you are telling me that for your guidance, you don't expect any buybacks? Quite surprising, right? You can go back in the history. This is not the first time Fortinet is doing this. They don't assume any buybacks for their guidance. Guess what? And then they beat the estimates from Wall Street because earnings per share is fueled up by the buybacks. So I think the guidance is very conservative. I think they will grow by more than this for the revenue and billings, etc. And I think the earnings per share will grow more because of buybacks. Okay? I've seen no one on Twitter talk about this. I've seen no one on YouTube talking about this. So you know what to do. You can leave a like to thank the algorithm, and it will help the video help other people. Okay, let me scroll down and see if I have another thing to show you, or we can go to the slides. We can talk about the balance sheet a little bit. For the balance sheet, you have a few things to monitor. You have the cash and cash equivalent that went down year on year from 2.8 to 2.4. Why is the cash down $400 million if you have done no buybacks? Where did it go? And I think I have the answer. Long-term investments. You have a new line in the balance sheet, approximately $300 million. Long-term investments. My question is, will they mention this new line on the call? What is that? Also, so this is minimal. The balance sheet is still good. You have a lot of cash. And for the liabilities, you have the long-term debt that was reduced from $1 billion to $500 million because you have this current portion of long-term debt. Long-term debt becomes short-term debt. They will have to repay $500 million of debt this year. So maybe they took this cash out of this cash pile in provision to pay the debt. Maybe it's possible, but maybe they will have to talk about this in the earnings call. So the company has a low debt level. The company is filled with cash. The company is in a very, very, very good shape. Also, I will skip this part about the income statement because I already did the work on my Google spreadsheet. So you will have even more information, more analysis, better analysis. And what about the cash flow statement? You have a few things in the cash flow statement. A few things I have highlighted were the inventory line. Last year, they sold out a lot of inventory. And you see 130, this is a cash inflow. The number is positive, so they got cash. They sold inventory, okay? They sold inventory, they received the cash. Now they built up inventory. You have brackets, this is a negative number. So they are building up inventory. On the call, do they say something about memory prices? You know that Fortinet is selling hardware, and you also know that memory prices are going up. Memory chips are going up. It will impact margins. It will impact costs for hardware. How bad is it? What is the impact? Is this affecting your inventory? How long is your inventory cycle? How many units do you have in advance? 3 months, 5 months, 6 months, 12 months, 10 months? I want to have a few answers on this call. Cost of memory and inventory duration. These are the two things I want to know on the call if they share this data. What about the cash flow statement? Nothing is important here. If I don't highlight it, I think it's not important. You have the CapEx here. What is really intriguing is last year, the CapEx was $380 million. And now the CapEx is $360 million. So they reduced the CapEx. Last year, they said, guys, expect more CapEx because we want to build our own stuff with more efficiency. It will be faster for our customers. So maybe you can expect more CapEx. And now in 2025, the CapEx has been reduced. So maybe the data center build out is over. Maybe it is finished. What is happening? Something to monitor. Maybe they will say something on the call. Okay, fair enough. This is for the cash flow statement. I have a last thing I want to share with you, and then we will go to the slides. Where is it? No. Oh, no, it was something at the end of the document, but the slides. Okay, we are done with the report. First document over. I hope it was clear. Second document I want to share with you and analyze is the slide deck, the investor presentation, because it gives us additional information. So you can cross-read between different documents and cross-read between this and the earnings call to really understand the big picture, what is happening for Fortinet. So, first slide, they are very proud of saying our billings are up 18%, revenue up 15%, product is reaccelerating, 20% growth rate. You have 42% growth year on year in value of deals above $1 million. So they are very proud of saying we are accelerating, we are profitable, and the margins are nice. After this, they talk about their three key segments. Where can I put my face? They talk about continued growth across all three pillars. First of all, the secure networking hardware that is growing right now at 12%, and that is expected to grow in the future for the next 4 or 5 years to grow at 7% per year. The hardware segment is the legacy segment. It will not change the world. The thing that is really promising in the future is the unified SASE that is growing 24% for their billings. And for this quarter, it has grown 40%. In the next 5 years, this segment is expected to grow at 18% per year. This is very promising. And the third segment is AI-driven security operations. The overall billing growth has been 22%, so double digits, very nice. But what is bad, and why I put it in red, is the billings growth for this quarter has only been 6%. Why is the billing growth decelerating in Q4? Any reasons? You see, now we already have a few questions, and I actually look forward to listening to the earnings calls to see if they discuss these points. When you are analyzing a report, always ask questions. Why? What is happening? This. You have to see what is important, what is not important. And for the things that are important, you want to see why. Why are all the moving parts moving like this? And this segment is expected to grow at 10% per year. And this is where I want to show the last slide. In the last slide of the presentation, they mentioned the historical billings and annual recurring revenue for Unified SASE and SecOps. Unified SASE, as you can see here in yellow, that's $1.2 billion in revenue, so quite big. And for SecOps, $500 million in revenue. Okay, so way smaller. The billings are very important. What I have written in red here, look at this, Unified SASE, year-on-year growth for the billings. In the past, the billings for the SASE segment were growing at 10%, 14%, 21, 16, 21, 17, 16%, and now 40%. Boom! I mean, this is very bullish for the reacceleration in 2026. For some reason, the billings for SASE has doubled in growth rates. Why? Maybe explain more on the call what is happening. The counter argument of this is for SecOps, you have a year-on-year growth of billings 22, 32, 37, 19, and now why is the billings growth rate at 6%? I mean, you can look at the past fourth quarter, the growth rate was also 7%, so maybe it's seasonal. But you still want to understand why you have such a deceleration, and do you expect a strong rebound? Anyway, we are in front of the next leg of growth for Fortinet. This will be extremely important. Let me continue. No, not important. Not important. They talk about their technology, their clients, how efficient they are. They are the fastest growing SASE leader at scale for several reasons. One, they have the best value and security. Customer benefit, lower TCO, higher availability, proven results, 1/3 of the cost. Basically, this is their justification for CapEx. They want to build their own data centers. They have 200 global cloud locations with 5 million square feet total facilities, delivering the best security with the highest return on investment. This is why they create this CapEx, because they want to be close to customers, to be very efficient and very cost efficient. So this is their justification for CapEx. Second point, they are very easy to adopt. You have one single operating system, one OS across firewall, SD-WAN, and SASE. So this is a single platform, and this is their argument to compete with Palo Alto Networks and CrowdStrike. Now, we are in 2026, but the trends were valid in 2025. People don't want complexity. People want simplicity. People want one mega platform for their cybersecurity vendors. They don't want to deal with several things at the same time. You want one mega platform, one thing to deal with everything. So Palo Alto Networks is the best at doing this. They have made plenty of acquisitions. Palo Alto Networks is another company in the cybersecurity industry. They did a lot of acquisitions and they unify everything into one mega platform. CrowdStrike is also doing this, another cybersecurity vendor. This is the best when it comes to AI, with the Falcon, etc., reaccelerating really fast. They have one mega app, mega platform. Fortinet is doing the same thing, and they're very proud of saying, yeah, we have one mega platform. This is an argument to compete with the two other big boys. And then broader solution, I think this is not important. Let me scroll down. These are all the data center locations they have, and all the point of presence the company has. This is increasing. This is a proof of CapEx. They talk about their technology, and now they talk about the billings. We talked before about the billings for 3 segments: hardware, SASE, SecOps. Billings mix is shifting towards the faster growing pillars of unified SASE and SecOps with a higher services mix. In 2023, the billings were 70% hardware, 30% software. In 2024, the share of software has gone up from 30 to 34. In 2025, has gone up to 35 to 36. So the high margin segments are growing in terms of importance because they are growing 24%. They are growing more than the hardware segment. So of course, in the coming years, 2026, 2027, 2028, etc., this share from billings will increase. It will become 40%, 45%, of course. Then they talk about AI, not important. Quantum, not important. I can show you the billings. The overall billings are up 16%, but for SASE, we are up more than the average, 24%, SecOps 22%. Actually, 1 year ago, the SASE billings were 22% of the billings, and because they have grown so much, 40% year on year, we are now 27% of the billings. Anyway, now, yeah, this is not good for this one. Okay, I think we are done with the slides actually. They show a great slide to show you how the product revenue has a lag with the service revenue. Product revenue is a leading indicator of future service revenue growth. This is in blue, you have the revenue growth for product, and in red, you have the service revenue growth. So in blue, hardware, in red, software. As you can see, for the past 15 years, the blue has a lag with the red. The red has a lag with the blue. First, the blue moves up. Like, look at this in 2013, it bottomed. 2014, the blue line goes up, so products goes up, and then you wait 1 or 2 years, and boom, you have the red line that goes up. And then the blue line goes down, red line goes down. And then in 2021, the blue line goes up a lot. You wait 1 or 2 years, and boom, the red line goes up a lot. And same thing, it goes down, it goes down. And what can you see right now? You see that for 2025, the product revenue growth has bottomed, and it is now reaccelerating. What does it mean? It means that almost for certainty, almost guarantee, 99% chance of happening, the red line will reaccelerate. And you're telling me that for the guidance, they expect a growth rate of 11% per year? I don't think so. The guidance is so conservative. The business is reaccelerating. They are telling the world we are reaccelerating. They are sharing this slide saying, guys, we will reaccelerate. Look at our past, look at our track record. But despite all of these signs, they are guiding conservatively. I think they will do better than these numbers. I think the guidance is very conservative. Next slide. Rule of 45, I don't care about this, not important. They have slide 22, they talk about buybacks, which shows you that buybacks were not important for this quarter. Anyway, we learned that in 2026, they did a buyback program of $300 million. This 2026 buyback program is not priced in the guidance for 2026. The management is conservative. Yes. Now they talk about their long-term targets. Pretty important, right? For 2026, they expect a revenue growth rate of 12%. We already said we expect more. Well, I expect more. And for the 3 to 5 years in the future, they expect the revenue to grow at 12% minimum, faster than the market. If the market is growing at 15%, they say we will do better than the market, so we'll do better than 15%. Anyway, I think they are being very conservative here. These are guidance, and they are guiding for CapEx, what they call infrastructure investments. This is the same as CapEx. They changed the wording. You can check the past slides for the past year, 2 years, 3 years. In the past, you had the same slide, but you didn't have a line called infrastructure investments. You had a line called CapEx. So please, when you read infrastructure investments, you can read CapEx. They are guiding for a CapEx for 2026 between $350 million and $450 million. Is it big or not? Will they do more or less? Now we just learned with Amazon and Google and Meta that they are always increasing the guidance for CapEx and CapEx and CapEx. What is the track record of Fortinet? Well, we have done the work already. So let me zoom in so you see better. I did the work so you don't have to. For last year, they expected a CapEx of $380 million to $430 million, and they did 365 CapEx in 2025. So last year, for the full year of 2025, they expected a guidance that was a little bit high. They did lower than their own guidance. Okay, what about last year, 2024? They expected a guidance of between $370 million to $420 million, and they did in the middle of this, 385 in 2024. So the guidance was respected. What about last year, 2023? They expected something between $400 million and $450 million. They did $200 million. So it was way lower than the guidance. And what about before 2022? They expected the guidance between 270 and 300, and they did the middle of this, $280 million of capex in 2022. So they respected their guidance. What it means is Fortinet does not have a history of putting a guidance and doing more capex than expected. Actually, it's the reverse. Either you respect your guidance for capex, or you do lower than what you guide. And in a world where you have so many uncertainties when it comes to capex and AI, and will you have a good return on investment with your capex for Google, for Amazon? Is this a lot of cost? Do you expect the cost to grow significantly in the future? Fortinet is playing the game of efficiency. Fortinet is being conservative. They don't want to overpay. They want to build up their own data centers, but they are not hungry to eat the world. They are playing defensive, conservative, focus on free cash flow and efficiency first. Focus on shareholders. And this is the reason why I am invested in Fortinet and not other players in the industry. Because Fortinet respects their shareholders. They want to have as much free cash flow as possible, and they want to reward shareholders with buybacks. They focus on margins. They focus on efficiency. And I love it. The company has always been profitable since they became public in 2009. The company is dedicated to shareholders. You have the two founders that are still here, CEO and CTO of the company. The two founders still own 15% of the shares. So the incentives are pretty much aligned. They focus on per share metrics. And these are all the reasons why out of all the cybersecurity players, I am invested in Fortinet. They are very focused on the shareholders and free cash flow. Next slide, that's the appendix. No, this. I am done with the slides. Now we will go through my Google spreadsheet and you will see the kind of analysis I am doing. Okay, let me zoom in. I hope you like this format. Okay, perfect. So I created this spreadsheet for the fourth quarter of 2025 with what we have with the report. So you have several lines, etc. for the last quarter of 2025, and the last quarter of 2024, and the growth rate for product and for service. For the products, product revenue is up 20%. As I showed you before, it's a nice reacceleration. For the service revenue is up 11.7%. It's not that good. Actually, I can show you again what is happening here. You have a few segments, percentage change. You have the product revenue that I showed you before is up 20% and reaccelerating. This is the best growth rate we've had since 2023. This is lovely. And you have what is called the service revenue that is down. As always, now you know you have a lag between these two elements. So it's okay if you, this is a lagging indicator. First, products, you wait a couple of quarters, and then software will go up. And inside this service line, you have what is called security and subscription and technical supports. Two lines, when combined, you create the service revenues. The red line, security subscription, is down, and the blue line, technical support, is flat, reaccelerating a little bit, maybe bottoming out. Okay, in terms of importance, that's roughly equivalent. Let's go back to the sheet I have here, the spreadsheet. For products, this is the highest growth rate since the fourth quarter of 2023. This is the most important for Fortinet because this is the first indicator of growth. First, you grow your products, and then all the rest follows. But this is your leading indicator, so very, very important. Maybe the most important metric out of all this report. The products are up 20%. And for the services, security subscription still decelerating, I just showed you, and technical segments growth rate is stable. Security subscription growth rate down. No, decelerating. Yeah, that's down and decelerating. Still a 10 or 11%, but decelerating, which means the total revenue of the business is up 14.75%. And at the same time, billings are up 18.47%. This is a good reacceleration. We did not have this last quarter. It seems like this quarter, everything is reaccelerating for the whole business as a whole. This is the highest growth rate we've had for billings since the first quarter of 2023. Also, the remaining performance obligations are up only 12%, but maybe bottoming. I can show you what I mean. I can show you the growth rate of billings over time, and I can show you the total remaining performance obligations. These two lines. You can see the red line, the billings, rebounding. This is your future revenue. The billings already contracted. At 18%, the business is reaccelerating. And for the remaining performance obligation, this is what you have. Maybe bottoming out at 12% per year now. So pretty good, pretty happy with that actually. Now, this is where I don't like it. This is why I put this in red. The cost of product revenue is up 28%. So as a reminder, The revenue is up 20%, but the costs are up 28%. You have a huge cost increase. My question is why? Because of the cost of memory going up? Why? I want to know on the call why is the cost so much higher than the revenue? And then for the cost of service, it's up 17%. Also bad, I can put this in red also. The service revenue is up, let's say 12%, but the cost of service is up 17%. So for both segments, margins are going down. The overall cost of revenue is up 25-26%, which means for the product segment, the gross margins are going down from 69% to 67%, and for the service, the margins are going down from 87% to 86.8%. For service, we are talking about peanuts. I'm aware we are talking about decimals here, but still, this is a trend. My question is this temporary because of memory prices or permanent because of a new change? When you are a business about efficiency, you want to squeeze the margins. You want margins as high as possible. So maybe you have more investments, short term, long term, what is happening here? And I can show you the chart, the gross margins of both segments. As you can see here, the blue line, that's the gross margins for product. As you can see, since 2024, the margins went from 55 to 65%. And now they are down a little bit, but we're still at a high plateau. And for the services, we are roughly stable. Roughly, I mean, the red line here, we are talking about peanuts. This is 86, 85, 87, still high, okay? But yeah, maybe for the blue line, for the hardware segment, why is it down? I suspect it's because of memory prices. If this is because of memory prices, this is a temporary issue. I don't think the situation will last forever. Well, we will see. Okay, if you sum it all, you have a total revenue growth rate of 14% and a gross profit up 12%. The overall margins are down. Temporary or not, this is something to monitor on during the call. Now about the operating expenses, okay? The research and development costs are up 7%. This is good. Fortinet has a history of being very efficient for their R&D expenses. In the last quarter, I can show you the other tab here. In the last quarter, they had R&D expense of 8%, going up 8%, now 7%. They are getting even more efficient. For sales and marketing, the cost is up 19%, 20%. And I put this in green because I think that's a positive. Because the management knows they want to reaccelerate. They know they are here, they have great margins, they are net cash. They can burn cash a little bit to reaccelerate your revenue. How can you reaccelerate your revenue? You have to sell more. So they are aggressive to hire more salespeople, marketing people, advertising. They are aggressive for sales reacceleration, which is a third reason why I am intrigued by their guidance. They expect a growth rate of 11-12% per year, but all the elements point to a reacceleration, and the management knows it quite well. They are incentivizing more salesmen. They are maybe hiring more people in the marketing department. So they are hiring more, they are investing more, they are reaccelerating more, and still they are being very prudent in the guidance. So the management knows very well what they are doing. They want to reaccelerate the revenue. About general and administrative costs, this is irrelevant. We are talking about peanuts, $50 million here, irrelevant. And this, I don't care. Which means the total operating expenses are up 17%. And now you can compare the gross profits up 12%, the operating expenses up 16%. So the operating income will grow by less than this. The operating income is up 9%. Which means the operating margins went down during this quarter from 34% EBIT margins to 32.8% EBIT margins. We lost 1% or something like this, 1.5%, 2% anyway. The EBIT CAGR, EBIT means operating income CAGR, compound annual growth rate, is inferior to the revenue CAGR. I mean, I should put not CAGR, but this is the growth rate. GR for growth rate, growth rate. Normally you have the reverse and you can talk about CAGR. So the growth rate is inferior to the revenue. Revenue is going up 15%, operating income 9%, but now you understand why. Higher cost because of memory, and also the business is willingly becoming less efficient because they want to favor growth in the future by hiring more, for example. Okay? Add to this, if you go down to the income statement, you have interest income that went down from $40 million to $30 million. They have less interest income because they have less cash. I can remind you that they did a huge buyback program last quarter, so they have less cash on the balance sheet. And when you have cash on the balance sheet, you can invest in short-term bonds, right? That will give you a little bit of gains in short-term maturities, so a little bit of interest out of your cash. If you have less cash, you have less investments in short-term bonds, so less interest income. And two, we already said this in the debt in the balance sheet, they will have to repay $500 million of debt. Long-term debt became short-term debt. So maybe they created a provision in their balance sheet of $500 million of cash. So one, you have less cash because you are doing buybacks. Two, you have maybe less cash because you have provisions to pay off your debt. Two reasons, I believe, why the interest income is down year on year. This is irrelevant, which means with these small adjustments, the income, the profits before taxes is up only 5%. This is a shrinking pie. We went from 14-15% revenue growth rate, more costs, less profits because of the cash balance, and the pre-tax profit is only up 5%. Yep. This is not so great actually. You have a cash management that impacted the pre-tax income. But don't worry guys, the story is not finished. You have to pay your taxes. And last year, the tax rate was 14%. 14% tax rate. Now you have 22% tax rate. The tax rate increased. The taxes were up 67%. So that's a massive tax increase. And I said, I don't expect the tax rate to increase next year. You have better comps. And don't worry, I can show you this chart so you don't have to do any work. Enjoy the show, guys. Take some popcorn, leave a like to the video, comment. This is your effective tax rate for Fortinet. Widely fluctuating, I agree with you. During 2020, 2021, the tax rate was 5%, 0%, very, very low tax rate. In 2023, 2024, 2025, the tax rate increased. And as you can see here, for December 2025, at the right of your screen, the tax rate has now become 22%, which is maybe the highest tax rate of the decade for this company. Which means for next year, to compare apples to apples between different quarters, different years, the comps are way better. You will no longer have a big gap of taxes. For next year, for 2026, it will be fine. You will not have this negative impact to compare the tax rate. The base tax rate will be fine. So now I checked what is the tax rate guidance for 2026. They expect the tax rate to be the same. So actually we will be able to compare apples to apples normally. That's in theory. In practice, you have two scenarios that can happen. Either the tax rate is the same, so it's perfect, you can compare apples to apples, or the tax rate goes down in 2026 and it will be a positive, a tailwind to the profits. But you will no longer have this additional headwind of massive taxes. I don't think so. Then you have zero here for some reason. Anyway, the net income, if you account for the taxes and costs, the net income is down for this quarter on a year-on-year basis, down 4%, which is surprising, right? We started from a very good revenue growth rate, but the net income is down. And I can show you the net income over time. This is your net income over time on a quarterly basis. Look at this. This is your net income on a quarterly basis for Fortinet. You can see that now we are at $506 million. This is what you have here, $506 million. And you can see big spikes in net income last year. Look at this, December 2024 and September 2024, big spikes. So the year-on-year comparison is challenged because of this. We had the exact same situation in December 2018 and December 2019. And look at this, it's very hard to beat the number you had the year prior if you had a huge net income the year prior. So it's not because the business is bad. It's not because the business is decelerating. Look at the chart. The chart speaks for itself. It's just that last year, the business made a lot of money, was very profitable. I'm not putting a spreadsheet and telling you the business is dying and slowing. No, guys, look at the chart. It's quite telling actually. It's just that the year-on-year comparison is challenging. Now the net income is down 3-4%. The company is doing buybacks. Maybe not this quarter, but on a year-on-year comparison, they did buybacks. They had a strong buyback program in the third quarter. So they bought back 3% of their shares, which means the EPS, earnings per share, is flat. Net income down 3%, you do 3% buybacks, you're up, down 3%, that's flat. To be honest, I expected more buybacks in Q4. So I have some questions why the management did not do any buybacks in Q4. Okay, now you understand all the moving parts for the income statement. We have covered the balance sheet, the income statement, the cash flow statement. We have already maybe 10 questions prepared for the earnings call. And do you have something else? I have some comments to make. So, growth is reaccelerating. We have the proof already. Margins are down. We want to ask why. Fortinet is known for their good cost control and efficiency. Why are margins down? Maybe this is temporary because of memory prices. Maybe the next quarter will be better. I don't know. Lower margins plus cash management plus more taxes equals stable earnings. Earnings are stable. Earnings per share are stable, I would say, because all of these metrics, okay, you now understand why net income is flat. Tax rate will no longer be a headwind in 2026 because the base rate is already so high. And in terms of geographies, I already did the work. Europe is reaccelerating. That's their biggest segment. Asia is stable. And North America is bottoming out and reaccelerating a little bit. Positive. In terms of cash flows, you are maybe invested in Fortinet because of the cash flows. The operating cash flows improved a lot, plus 30%. And in terms of CapEx, as we said previously, the CapEx is down minus 50%, cut in half, which is really surprising because during 2025, they said they would increase the CapEx. Apparently, it is no longer the case. Why? Why did you say you would increase CapEx and now you are reducing CapEx? Doesn't make any sense. Are you backing down? Are you changing? Are you pivoting? Maybe something to monitor here. Because the company, Fortinet, is known for having minimal CapEx. So it was very strange for me to say, we are going to have some CapEx now. And then you back off. So I would be very happy if they reduce the CapEx actually. Because that's more cash flows for me and more buybacks for me. So more earnings per share improvement. So better stock prices over time. So I'm really looking forward to seeing what they say. What is strange is they had a huge buyback, $1.8 billion in Q3, and now they stopped buyback in Q4, although the stock price was at the same price. Very strange. Also, they resumed buyback in the fourth quarter of 2026. Maybe they didn't do buybacks in Q4 because they knew they would beat analyst estimates. But in the first quarter of 2026, they want to fuel returns a little bit. Maybe this is my guess. They were very positive and optimistic for this quarter. So no buybacks to improve the returns a little bit. But maybe the first quarter will be a little bit more challenging for cost, for example, for margins, for example. Maybe cost, because of memory, are going up, margins are going up. So you want to improve the bottom line a little bit and you are doing massive buybacks. Maybe. We will see what happens for the first quarter of 2026. Management, I said, is very prudent for next year's guidance. I think they will beat estimates for revenue and earnings per share, also because buybacks are not priced in. The bull thesis is still intact, the core operations are still very healthy, and the business can reaccelerate. In the call, what we are going to do right now, we will watch for SASE growth, especially billings and migration from SD1, the mix shift, recurring revenue and pure hardware, the guidance for free cash flow and capex, the margin trends, the impact of memory prices and inventory management, and any commentary on upgrade cycle status. How far along customers are in renewal firewalls. Also, any comments on future buybacks, obviously, and the impact of AI on the cybersecurity industry. These are all the elements we will monitor when we will listen to the earnings call. By the way, if you want to know how I did all this research, I just recorded a big masterclass, a 2 hours long video, how I show you step by step how I do the research, how I show you how I highlight in different colors, how I'm exactly doing step by step the analysis. It's very complete, and that's all the preparation work I do before recording these videos. The video, I have the rush here, 1 hour and 50 minutes. If you, and I'm doing the Google spreadsheet at the same time, it will be pretty helpful to you if you want to know how you can do this for you and your stocks, the kind of comments, where to find the information, what is important, what is not important, how to build your own spreadsheet. I'm doing the work. This is a behind the scenes video that is available for members of this channel. So I highly recommend you watch it if you want to learn the step-by-step process, the behind the scenes videos. Okay, now let's go and listen to the earnings call.
Good afternoon, and thank you for joining us on today's conference call to discuss Fortinet's fourth quarter and full year 2025 financial results. Joining me on today's call are Ken Xie, Fortinet's founder, chairman, and CEO, Christiane Ohlgart, our CFO, and John Whittle, our COO. Ken will begin our call today by providing a high-level perspective on our business. Christiane will then review our financial results for the fourth quarter.
Thank you, Anthony, and thank you to everyone for joining our call. We are very pleased with our excellent fourth quarter growth, driven by broad-based demand.
Yeah, let me tell you first that Ken Xie, the CEO, has a strong Chinese accent. Be careful.
And across our platform, as building increase.
And we are very lucky we have the transcript in real time. It will be pretty helpful.
18% and revenue growth 15%, driven by product revenue growth of 20%. Operation margin was strong and 37%, reflecting our continued focus on balancing growth of profitability. Secure networking building growth 13%, outperforming the overall secure networking market as we continue to gain market share. Fortinet remained the #1 firewall leader with a 55% unit market share and the highest product revenue among our cybersecurity peers. Fortinet has led the convergence of networking and security for over 25 years, and secure networking is expected to surpass the traditional networking by the end of this year. Our firewall leadership is driven by FortiOS, which unified the networking and security, and our FortiASIC technology.
Yeah, this is the mega app I was talking about, the unified platform, the one all-inclusive platform they have.
Deliver 5 to 10x better performance than competitors while lowering the total cost of ownership and energy consumption, which provide a large advantage and securing AI data center. We will introduce the FortiOS 8.0 and the Fortinet's annual customer and partner conference accelerate in March, featuring significant new capability in security and networking, especially in AI security, such as agentic AI security in the enterprise, plus a new bundled SD1 and SASE service. We also recently partnered with NVIDIA to leverage their Bluefield 3 DPU to secure AI infrastructure. Unified SASE building grew 40%, representing 27% of the total building, supporting our belief that Fortinet is the fastest growing SASE leader at scale. Our momentum is powered by 3 key advantages. First, Fortinet uniquely integrate next-gen firewall, SD-WAN, and SASE on a single OS, FortiOS, running on-premise or in the cloud, allowing customers to expand SASE in minutes and driven upsell across a large customer base. Second, we support in both sovereign SASE and public SASE. Sovereign SASE enable enterprise and service provider to deploy SASE in their own data center to meet the data privacy, sovereignty, and compliance requirement. We are seeing strong demand in sovereign SASE, and none of our major SASE competitors offer sovereign SASE solution, making Fortinet's total unified SASE addressable market significantly greater than our peers. Third, our owned and long-term invested global cloud infrastructure, FortiCloud, delivers high performance and security and roughly 1/3 the total cost of ownership of our peers. These differentiators position Fortinet as a leader in the 2025 Gartner Magic Quadrant for SASE platform as we continue to be the leader in SD-WAN, and I believe we'll be the #1 unified SASE within the next few years. AI-driven secure outbuilding growth 6% in the fourth quarter and 22% for the full year, while ARR was up 21%. Our strong performance was driven by more than 20 AI-powered solutions as customers consolidate multiple security vendors onto Fortinet's platform. In addition, Fortinet's leadership in security also extends to operational technology and a cyber physical system, offering enhanced visibility, robust threat protection, and secure connectivity. The demand for OT solution is driving significant growth, with building up more than 25%. Finally, we reaffirm the midterm target we shared at our Analyst Day, reinforcing our commitment to continue grow faster than the overall market, including delivering billion and revenue CAGR above the market growth of 12% and achieving the Rule of 45. I would like to thank our employees, customers, partners.
Okay, basically repeating what we have, but he told us additional informations about their different segments and their moat and their cost efficiency. Now the CFO will talk about the numbers, and you want a fun fact: every time the CEO speaks, this is a new CFO, sorry, she is German. I mean, she has a German accent. I suppose she's from Germany. Every time she speaks, the stock goes down. Okay, so seems like Wall Street doesn't like her, and when she speaks, the tone is more negative than when the CEO speaks. And of course, Wall Street doesn't like when the CFO is negative. It's about hard data. So I will see if Christian here is being more positive on the call. It's details, but sometimes that's things that can influence stock prices in the short term.
Thank you, Ken, and good afternoon, everyone. As Ken mentioned, we are very pleased with our strong fourth quarter performance, exceeding the high end of guidance across billings, total revenue, and operating margins. This outperformance reflects solid global execution and broad-based demand for our solutions, with product revenue growth accelerating in the second half of the year. We are well positioned to deliver durable, long-term growth as a leader in large and rapidly expanding cybersecurity markets, including secure networking, unified SASE, and security operations. This opportunity is supported by strong secular tailwinds, such as vendor consolidation, the convergence of security and networking, ongoing technology upgrades, and the expansion of enterprise attack surfaces across cloud, OT, and AI. Our strong network security foundation drives adoption of SD-WAN, SASE, and SecOps, while creating significant opportunities to upsell integrated solutions across enterprise customers. Building on these market dynamics, our leadership in secure networking, combined with our unified FortiOS operating system and broad platform, enables customers to deploy security anywhere across private, public, and hybrid multi-cloud environments, and in any form factor, including hardware, software, and SaaS. As a result, our platform approach drives strong customer expansion, increases wallet share, and supports growth across both existing and new markets. In addition, we benefit from durable competitive advantages through our proprietary ASIC technology and single integrated operating system, which delivers superior performance, lower total cost of ownership, and meaningful differentiation versus peers.
Yes.
At the same time, continued investment in R&D across custom silicon, OS convergence, AI-driven security, quantum readiness, and Fortinet-owned cloud infrastructure supports rapid innovation and organic growth. Finally, our highly diversified business across geographies, customer segments, and industry verticals reduces volatility and enhances resilience across economic cycles.
For the moment, very positive.
Complementing this diversification, we operate a strong and balanced model with a Rule of 45 plus profile, robust recurring revenues, strong free cash flow generation, a solid balance sheet, and a disciplined shareholder-focused capital allocation strategy. This balanced model supports our confidence in our 2026 guidance and continued long-term shareholder value creation. Now moving to an overview of our strong fourth quarter results.
Okay, they talk about the numbers that we have already covered, so let me skip it. Billing growth over 25%, broad-based demand. We have momentum. Number of deals greater than $1 million increased by 30%, and the deal value is immense. US and Europe were the largest contributor to big deals, 30%. We are accelerating. We continue to expand our customer base. Strong position. We are growing recurring revenue. Blah, 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 blah. Revenue is up 15%. Product revenue increased by 20%, so you have a strong performance. Both hardware and software grew 20%. Technological updates, upselling, expansion. Service revenue grew 12%. As a reminder, we view product revenue growth as a leading indicator of future service revenue growth, as shown on slide 20. I showed you before. And if products are reaccelerating, services will reaccelerate soon, and the guidance is too low. Now I'd like to highlight a key deals that would demonstrate our market leadership. Okay, you know what? Let me go back here.
Now I'd like to highlight some key deals that demonstrated our market leadership and customer expansion. In the competitive seven-figure upsell deal, a large consumer services company, an existing 41 SD-WAN customer, selected FortiSASE to secure more than 10,000 users as part of its next-generation access and security transformation. The win was driven by our single OS approach that tightly integrates SD-WAN and SASE, enabling rapid expansion to SASE and delivering strong performance at a meaningfully lower total cost of ownership. The customer chose Fortinet for our unified FortiOS operating system, which reduces complexity by enabling a single, consistent security policy across FortiSASE and FortiGate devices, while leveraging our globally distributed POPs. By integrating our POPs into their existing...
POPs is a point of presence, right? You have slides in the investor presentation about all their POPs. Here, boom, okay.
Existing SD-WAN fabric, the customer has simplified centralized policy management and enabled secure private access at scale, which highlights our platform model. Next, a leading global data center provider supporting AI and cloud workloads signed an 8-figure deal with Fortinet to support its rapid global expansion. The customer selected Fortinet for a predictable, scalable investment model that aligns security growth with its accelerated data center build-out. As the company standardizes on our FortiGates, FortiSwitches, and FortiAPs, our solutions will streamline operations across IT and OT environments, including critical power, cooling, and physical security systems. This strategic partnership enables the customer to scale securely and consistently, supporting its long-term global growth strategy. In another key win, a major utility company expanded its partnership with us through a high seven-figure agreement to secure its operational technology environment. The deal includes a comprehensive set of solutions covering network segmentation, identity and access management, and zero-day threat detection across the utility's advanced distribution management system, along with the adoption of FortiAI. This competitive win was driven by our ability to automate critical security operations, our proven expertise in protecting critical national infrastructure, and a compelling price for performance advantage. Lastly, in a competitive displacement win, a Fortune 100 company signed an 8-figure multi-year agreement for unified SASE, selecting our virtual firewall solution to secure approximately 1,800 store locations. The customer chose FortiGate VM through our FortiFlex points-based consumption program, which supports flexible hybrid firewall deployments and a broad set of security solutions. Fortinet was selected after a highly competitive evaluation due to the flexibility of the program and our ability to meet demanding technical requirements at scale. enabling the customer to consolidate security on a single architecture while gaining deployment flexibility, centralized management, and long-term cost efficiency to support future growth. Turning to margins and cash flow. Total gross margin of 80.3% was better than expected, which is especially impressive given the strong product revenue growth and related mix shift. Operating margin of 37.3% exceeded the high end of the guidance, mainly due to stronger than expected revenue growth and cost management. Free cash flow was very strong at $577 million, and adjusted free cash flow was $589 million, up $130 million, and represented a margin of 31%. We repurchased approximately 730,000 shares of common stock for $57 million during the fourth quarter, and an additional 4.6 million shares for $356 million quarter to date.
Okay.
In January, our board of directors approved a $1 billion increase in the authorized stock repurchase amount, and the remaining share repurchase authorization as of today is approximately $1.4 billion.
Okay.
Turning to
So they already started the buyback program. They don't have any comments when it comes to memory prices, and they talk about the full year results now. And on a full year result basis, the earnings per share are up. I mean, can I show you the earnings per share over time? Earnings per share are up. Look at this over time. Earnings per share up. Yes, year on year. It's just the comparison, the full year comparison is horrible. But as you can see here, we are still up and to the right. Lovely. Disclaimers regarding no. Moving on to guidance. We expect this for 14%. We expect the margin to be this, and they don't explain. We expect service revenue growth to pick up in the second half of 2026. Very important. Driven by accelerating product revenue growth as a key leading indicator. So, they expect the service segment to reaccelerate in the second half of 2026. What is the growth rate of service? Now the growth rate is 11%, 12%. On an annual basis, it is 13%. And the guidance they have is what? The guidance... Oh, come on. Where is it? Oh, no, it's in the other slide. Other document. The guidance for service is 11%. What? So what they are telling us is they expect the service segment to decline for the first half of 2026, to reaccelerate in the second half of 2026, and the average growth rate for the service segment should be around 11%. This is what they're telling us. So they expect this red line to go down badly to 8, 7%, or even, I don't know, 9, 10, and to reaccelerate. Can be the case. I would monitor this. What else? Gross margins of this. Non-GAAP tax rate of 18%. We assume a share count that is stable. This is the CapEx. We have already talked about this. I want to share a few modeling considerations. What is that?
Before we open it up for Q&A, I just wanted to share a few modeling considerations. As a reminder, the majority of our service revenue is recognized ratably on a daily basis, and the first quarter this year has 2 fewer days than Q4. From a margin perspective, our first quarter operating margin guidance reflects the timing of several marketing events. Additionally, the recent weakness of the US dollar may create a modest headwind in the first quarter.
Okay.
And finally, we plan to repay the first tranche in the amount of $500 million of our senior debt at maturity at the end of the first quarter. This, alongside lower market interest rates, will reduce net interest income for the year. As we look to 2026 and beyond.
Oh, that's good. That's good. They say, I mean, this answers one of our questions. They already had a lower interest income because they will have less cash, and they will have even less cash because in Q1, so the next quarter, they will repay $500 million of their debt. So you can expect this line to decrease, interest income. Interesting.
We are confident in our growth strategy, driven by significant secular tailwinds such as rising cybersecurity spend, the convergence of security and networking, vendor consolidation, and the increasing need to secure AI and OT environments. We believe we can sustain product revenue growth of 10 to 15% over the midterm on average and reaffirm the midterm target shared at our Analyst Day, including delivering billings and revenue CAGR above 12% and achieving the Rule of 45, reinforcing our commitment to continued growth beyond that of the overall market. Our leadership in innovation and price for performance enables the lower total cost of ownership across secure networking, unified SASE, and SecOps, positioning us to outperform the overall market. We are well positioned to deliver durable, long-term growth considering our highly diversified, cash-generative, and profitable business. I will now hand the call back
Q&A.
over to Anthony to begin the Q&A session.
Our first question comes from Shaul Ayal at TD Cowen. Shaul, your line is open. You may unmute and ask your question.
Thank you so much. Good afternoon, everybody. Congrats. Ken, I'm interested in what drove the strength or the change that you've seen during the quarter, specifically the unified SASE billings and the strong guide. What gives you confidence into 2026?
Yeah, that's a great question, Shaul. Thank you. Actually, you can see the unified SASE grow 40%. That's where we see probably the fast growing unified SASE vendor and scale. Because the three unique advantage I mentioned. First, actually, the sovereign SASE we see very strong growth. I believe the sovereign SASE market probably even bigger than the current public SASE. That's all the other vendor doing right now. But we don't see any of them try to get in the sovereign SASE or have the function to support in sovereign SASE, which we kind of designed the SASE in the beginning, try to support our service provider and all these things, which is all kind of sovereign SASE approach. That's have a huge growth. And the sovereign SASE, you only buy the product first, then deploy in the customer or service provider data center, and then we'll keep supporting with additional service. So that's a huge market opportunity. We believe we're the only leader in the space for the sovereign SASE. Second, we have a three function into single OS: network security, SD-WAN, and the SASE. That's actually give us a huge advantage, leverage our huge customer base, and none of the competitor had this advantage. And that's making us grow very quickly. Both our sales and the partner see the huge advantage, and the SASE ramp up very quickly. And then also long term, because our investment in the infrastructure, so we do see we have cost advantage. So our cost is about 1/3 compared to some other our competitors, right? So that's also we can pass all this kind of a cost saving to customer and play the long term game. That's we see drive our strong growth of a unified SASE.
Okay.
Maybe Christiana and John have some other point.
Yeah, he just said we have a mode, so people choose us. Okay, that's a weak answer. For the first time ever, your segment is growing 40% for your billings. Instead of growing 10 or 20%, you grow 40%. Has something changed? And the CEO said, people choose us because we are more efficient, we have a mode. Okay, well.
I think we saw really good traction on our execution in Q4, and it was very broad-based. So as you heard from me, I mean, we were great in enterprise. We executed well on the OT side. We had successes at SASE. AI was a big driver. So that gives us significant confidence for 2026 that these growth drivers are going to continue because the demand is definitely there.
Okay.
Yeah, I would just say, obviously the cybersecurity market is growing really nicely. As Ken highlighted, we have a lot of competitive advantages where we feel like we can grow faster than the market and faster than each of the three pillars that we focus on, as we did throughout 2025. And we see a lot of different growth drivers, amongst the three pillars, the OT momentum. We see opportunities with AI and with quantum. And when you look at our business, it's really diversified in a number of ways, geographically, based on customer segments, and also industry verticals. And then if you look at our solution sets as well, it's diversified amongst the three pillars that we focused on. And when we focus, we have a track record of doing really, really well.
Yes.
If you look at what we did in SD-WAN, We focused and did really, really well starting around 2018 or so, and really grew that business. And we're really focused on unified SaaS in these other areas as well, and expect to do well just like we've done in the past.
Got it. Thanks for this color. Maybe just a brief follow-up. Ken or team, what are your views on AI aiding software, specifically as it relates to cybersecurity?
Great question. This is maybe the most important question right now, given the SaaS apocalypse we have.
We have seen, we're sitting here in front of the screens. Probably everyone else of my peers here seen, software demise. Cyber has been holding a little better, but I think, today, the past few days, it hasn't been fun at all. Just curious as to your views, whether security actually augments AI or maybe it's the other way around.
AI definitely changing the especially enterprise landscape. Some software probably also need to be changing to see whether they take advantage of the AI or they kind of falling behind, which let AI to eat some of the software. But on the other side, we do see AI as an opportunity in the cybersecurity space because also how to control some of the AI. We do see in the enterprise environment is a kind of see some strong demand in whether internal segmentation to kind of control some of agentic AI or some other data leakage prevention. So on the other side, the AI data center also we see some huge opportunity there. I think we'll present more detail in the next month's Accelerate. If you see some of the presentation I did in the last few Accelerate, like 6 years ago, I do see the edge will eat the cloud and the mobile. So that's where I think that sometimes some of this like edge AI solution or edge and the immersive technology with AI, I think it will be kind of changing some of the traditional whether software infrastructure, which we keep we keep kind of prepared this in the last 5 to 10 years. So we see this as an opportunity to both leverage AI and also helping enterprise to secure AI.
Okay, basically, yes, it will improve our sector, but no specific details were given.
Thank you.
Our next question comes from Saket Kalia at Barclays. Saket, your line is open. You may unmute yourself and ask your question.
Okay, great. Hey guys, thanks for taking my questions here. Ken, maybe first for you, can you just talk a little bit about how you're navigating the current environment in memory?
Wonderful.
And maybe as part of that, Christiana, can you just talk about how you're thinking about the impact of higher memory prices as part of your guide in 2026?
What a lovely question. Thank you, Saket Kalia. Wonderful.
That's another great question. Actually, we prepare for this kind of supply chain since you can see 5 years ago when there's a supply chain issue during COVID, we're doing quite well because we do have inventory on average about 6 months, which try to buffer during this kind of time. Mm-hmm. And also we keep mentioning during the analyst day, we're maintain a healthy margin. So we're adjust by some of the price based on our own margin. And because even we adjust on recent price, we still have a huge advantage, like leverage our technology, whether the ASIC gave a 5 to 10. And because even we adjust on recent price, we still have a huge advantage, like leverage our technology, whether the ASIC gave a 5 to 10x better performance for the same function, same cost. And at the same time, the OS offer much more function than other competitors. So that even with a little bit raising price to maintain our margin, we still feel we are very competitive compared to any other.
Did he just say they are having pricing power? So even with a little bit recent price to maintain our margin, they increased the prices of their products to offset the higher cost of memory. So they increased the prices. Pricing power, very good. They are telling us, despite all this demand and this competitive landscape, we are increasing our prices. Customers pay more, so we can keep our margins, which shows us whether this margin problem is temporary or not. It is temporary, because you can increase your margins, and when in a couple of quarters, if or when memory prices go down, Fortinet will keep the high margins, high prices. So it is temporary. I have my answer.
Competitors. So we view this just like 5 years ago is an opportunity to gain in market share. So that's where we well prepared with good inventory and also managed operation, manufacture directly with our own operation center worldwide. And also with the technology, we feel we even little bit price raise, we still very competitive, will not reduce our growth or market share. Christiana, other things you want to add?
Yeah. As Ken mentioned, we are planning to maintain our kind of profitability and gross margins on our products in two ways, right? One is by negotiating and making sure we get the components early, but also we've already raised some prices where we have some component cost pressures, and we will potentially continue to do so throughout the year, depending on what the components prices do.
This is lovely. So if the memory prices are going up, if the costs are going up, they have the power to increase their prices. They are already planning to do this to maintain high margins. Very good.
Part helping the margin is we're starting to see the service revenue will be turn around probably during 2026 this year. And also when we shift in more sales into whether Unified SASE or the AI-driven secure op, which has the most service, we feel the margin also will be kind of improving from that angle, which has the most service. So that's also helping. But there's other things we also kind of measure, whether the currency issue or some other. But we feel we are prepared, and with all the diversification we have, whether by vertical, by geo, we feel we kind of maintain the margin and keeping the rule of 45.
Mm-hmm. Got it. Christiana, maybe for my follow-up for you, it was a great billings result in the quarter, and good to see the guide. Can you just, and apologies if I missed it, but can you just remind us what billings duration was this quarter? And to Ken's point, just as we think about that driving services revenue for next year, is there a way that you just have us think about the shape of services revenue for next year through the year?
So from a billings duration perspective, because of all the enterprise deals, it was slightly up. It's around 2.5 years, and so yeah, not too much different than it is normally in a Q4. Yeah.
Got it. Very helpful. Thanks.
Our next question comes from Rob Owens at Piper Sandler. Rob, your line is open. You may unmute and ask your question.
Great. Thank you for taking my question. I know you highlighted the sovereign versus public SASE as one of the strengths. Curious if you can give us a sense of what your actual revenue mix looks like, sovereign versus public, number one. And then number two, to kind of follow up on sockets, I think it was his third question, but I'm not going to call him out. When you look at the shape of services revenue and the recovery there, and I know you talked about the second half being stronger, but it doesn't seem to track with where you've been historically in terms of a recovery, given what you saw with product revenue this year. So is there something unique in 2026 or something unique going on that's causing that to lag just a little bit more than maybe you've seen historically? Thanks.
Good question.
For the service or product revenue, as you can refer to the page 20 on the presentation, we gave out the last 16 years since IPO, the growth between the service revenue and the product revenue. You can see the since change in the product revenue leading indicator of a service revenue. So we do believe this year with the last few quarter, with the product revenue in the last few quarter grow stronger. That's what helping drive the service revenue turn around, starting to grow faster. On the first question, sorry, what's the first question?
Sovereign versus public SASE mix.
Service. I believe the sovereign SASE market is probably even bigger than the public SASE market, but kind of approach is different. The sovereign SASE market, the service provider enterprise tend to buy the product first, which also we see the product growth very strong in Q4, and also believe will help drive this year product revenue growth with sovereign SASE. We have not compared the sovereign and also the public yet, but I believe probably pretty close to each other right now. But sovereign SASE, we see more strong growth because we don't see any of our competitor offer this sovereign SASE approach, and also with the product with the ASIC acceleration is a huge advantage for us. So that's why I do believe we have probably double the total addressable market in the SASE market with the sovereign SASE supporting the service provider enterprise with their own kind of SASE approach.
All right.
Okay, I hope you're following, guys, with the strong accent. He speaks like Li Lu with a Chinese accent. So if you've been following legendary investors like the Chinese Warren Buffett, Li Lu, you know this accent quite well.
Our next question comes from Gabriela Borges at Goldman Sachs. Gabriella, your line is open. You may.
Hey, good afternoon. Thank you. I know last year we shifted the conversation away from refresh tied to end of support and more towards refresh tied to technology upgrade cycles. Tell us a little bit, Ken and Christian, what you're seeing in the pipeline from the 2020 and 2021 refresh cohorts, their willingness to engage across the platform, and do those cohorts look more meaningful or notable than the cohort that you had refresh last year? Thank you.
Yeah, I think there's two things. One is really, we mentioned on end state is an end of a service, which we say there's 11 product, 12 product will be end of this year, may end of the service. But actually, doing some communication with the customers, some of them still want to are supporting beyond end of a service. So I think we kind of found some solution, probably win-win. We may extend the end of a service instead of try to force customer to buy the new product. We may give them actual extended service, but we do charge most service fee, both hardware, RMA fee, and also the maintenance software fee. So that's a win-win situation. And then also, like I said, that's not a major drive of this growth, because the growth more come from the new function, come from all these kind of like a new demand in the market. The second refresh is that's where in the past, probably the average hardware product, whether network security, networking, even server, probably after 5 to 6 years, they may have to add a new one. So we do see 5 years ago during the supply chain COVID time, there's a strong growth of product revenue. You can see on the page 20, the 21, 22, there's a pretty strong product revenue growth, like over 40%. Some of that one probably will help in the next couple of years, but like I said, the better driver will be new function, like how to support in the SASE in the ZTNA, Zero Trust Network environment, how to go internal segmentation, supporting enterprise to convert from the traditional networking to the network security, and helping the protect the data level, whether the data leakage or some kind of AI agent. That I feel is the one to drive the strong growth. Just like the strong growth comes from the unified SASE, it's 40% in Q4. I feel customer definitely more interested in if you have a better function and also kind of they can see the future of a long-term advantage. That's what more drive a customer to buy. Otherwise, they may replace the product with some other different vendor. So that I see is more important. We more focus on how the strong function, how the future kind of advantage we have, and also how to leverage the long-term investment we have, whether in the AI, in the quantum, in the infrastructure. That gives the customer confidence, also keeping or partner with the Fortinet.
Fortinet.
Thank you for the detail. Please, Christian.
Yeah, I would
Fortinet or 49. Choose the name of your company. Fiscal AI says the name of the company is 49.
confirm what Ken said. Based on the customer conversations we're having, the driver is that they need additional security, and so as they look at 40 SASE or similar, they upgrade their underlying technology at the edge as well.
Yes.
Yeah, that makes sense. Thank you. Ken, my follow-up is on how to think about the second derivative of AI compute demand, so more on the inference side. How does that impact what you see from a network security standpoint and a network traffic standpoint in particular?
That's everybody still kind of because the space changing so quick with AI. We're definitely working closely with our customer, with our engineer, try to develop all this technology, try to better protection. But in general, I think we kind of are more into to whether like the edge computing and also how the broad infrastructure protection instead of too much weight on certain cloud or certain software. That's where we kind of a lot of long-term investment we have, whether in the ASIC chip, in all this kind of system level, in the infrastructure level, and also in the supporting. I feel it's kind of more broad approach what will be helping better instead of just too much focus in one single area.
Our next question comes from Fatima Boolani at Citi. Fatima, your line is open. You may unmute and ask your question.
Oh, good afternoon. Thank you so much for taking my question. My first question is for you, Ken. The strength in unified SASE at 40%, your product growth this quarter in excess of 20%, that paints a really interesting picture that maybe is in contrast to some fears around SASE or FortiSASE rather being maybe a force of cannibalization of the product refresh opportunity. And I know you alluded to sovereign SASE specifically, but I'd be curious to get your perspective on how you are independently driving strong growth in SASE and independently driving strong growth from a product refresh perspective that doesn't seem to be affirming fears of cannibalization, especially for branch and branch location environments? And then I have a follow-up for Cristiano, please.
What a question.
I have to say that's the same SASE may cannibalize the some of the network and security come from some of our competitor. I never think SASE will be cannibalize all this network security, even a branch. I feel will be complement and also will be add on additional business opportunity. That's what we're doing both in the networking and traditional network security and also SD-WAN and SASE for many, many years. So from all angle, we do see SASE to offer additional business opportunity, additional product service, both in the customer level, in the service provider level, and also in some other like a branch approach. And eventually may even try to supporting working remotely, working from home, all this kind of approach. And also will be leverage both the infrastructure in the public cloud, in the colo, and also in own kind of infrastructure. So that's where we see there's a lot of different approach to SASE, and the different customer, different region may have a kind of different need. So that's where we kind of, in the very beginning when we developed SASE technology, probably like 6-7 years ago, we more believe the sovereign SASE service provider kind of SASE will be the future. That's where we kind of keeping investing in this area. But also like when we launched our own kind of SASE, maybe over 2 years ago, we also feel kind of working side by side with service provider of our own SASE and even some infrastructure also very, very important. So that's where we see the SASE actually will be complement, also will be additional business opportunity add beyond the traditional networking and network security. In the branch office, you still need a physical device. That's the advantage we have. We have like we call 3-in-1. You look at the networking device, network security device, and the SASE device into one solution, one for the OS, one for the FortiGate box in the branch office.
Yes.
That's probably not our competitor offer this kind of a solution, and that's we see is a huge opportunity. So we don't see SASE will be replaced branch office and network security solution. And you can see the unit shipment even in the branch office solution in the low end in the retail grow very, very strong. Some was because of SASE, but some also they try to deploy. I believe the future they can enable whether the SASE or the SD-WAN some other additional security service they needed. But they do need to have a device in the branch office. They do need some kind of a edge solution to handle all the both security and networking.
I really appreciate that detail. Thank you, Ken. Christiana, I want to go back to some of your comments with respect to pricing actions in response to an earlier question and something you mentioned in the prepared remarks. Was hoping you could quantify what degree of gross pricing increases you've been able to roll out in the base, and to the extent there's a net pricing yield associated with that, and how that's influencing your guidance. And maybe to take that a step further, is that one of the reasons why we're maybe seeing a slower ramp in the services trajectory of the business, because you are seeing a price action yield on the product, which may not necessarily be translating to services? I'd love for you to just explain that for all of us. Thank you very much.
Long question to say. You have increased your prices, but by how much? And maybe you are increasing your prices for products. What is the impact on services?
Very much.
So the pricing actions are on specific products, and of course dependent on the components that go into it. Overall, I think it's between 5 and 20%.
Okay.
But that also positively impacts services, because our service pricing is a percent of list price. But of course, it's going to take longer until that materializes in service revenue, right? So for product, you will see it in the next couple of quarters. For service revenue, it's going to take a bit.
Thank you.
Our next question comes from Junaid Siddiqui at Truist. Junaid, your line is open. You may unmute and ask your question.
Great. Thank you for taking my question. Just had a question on your software firewall business. As AI transformation across enterprises accelerate growth and cloud workloads, do you feel that your software firewall business, which has been growing at a nice rate, could inflect even further? And how do you think about that hardware-software firewall mix going forward?
I think Q4 we see the software firewall and the hardware firewall grow almost the same pace, about 20%. So the partnership with NVIDIA, the Bluefield 3 DPU, that's probably more leverage the software approach. And also we do working with some other service provider, cloud provider, to offer some software. But I do believe we have also more advantage leverage our own kind of a secure ASIC, which kind of give a 5 to 10 times better performance compared to some software approach, and with lower cost and That's probably, but I see so far it's almost the same growth pace.
For most of our enterprise customers, I would say that they have hybrid models, and so they buy our hardware, but they also buy virtual firewalls.
Great, thank you. I just got a follow-up as well. Great to see the billings number, but just wanted to ask about specifically billings for SecOps. It seems like it decelerated from Q3. Could you maybe just unpack that in terms of what were some of the drivers there?
Yeah, you had like a 7%, but or 6%. But as I told you, for the fourth quarter of last year, they were also 6 or 7%. So no big deal here. It's maybe seasonal.
Yeah, I don't want to call it a driver. I would say if you look at the annual billings growth for SecOps, it's very compelling. ARR growth is compelling, revenue is compelling. So billings is always a little bit of a more volatile number. Yeah? And in Q4, we had a lot of success in secure networking and unified SASE, but our SecOps portfolio is solid and we continue to see interest and demand. And so I wouldn't take this one quarter as a trend.
Yeah, also the secure networking and unified SASE can be a leading indicator for some future secure ops because they tend to buy the product first, and then eventually will also handle the additional operation service. I have to say, because a lot of our sales and the partners see the unified SASE demand so strong, they probably shifting more focus in that, and they can see that's more easy win. But secure ops is very long tail. We have so many different products with AI. I feel probably look at annual number will be more kind of reasonable instead of some quarterly number.
Our next question comes from Patrick Colville at Scotiabank. Patrick, your line is open. You may unmute and ask your question.
Thank you so much for taking my question, and nice end to 2025. Could I just get a clarification on the pricing comments? Because I thought that was interesting, and Fortinet is a company that over the years has clearly demonstrated pricing power. We saw that most evidently in 2021, 2022. Good to see that lever being pulled again. Christiana, did you say that expect pricing for appliances?
How many questions do you want on pricing power? She already answered.
Appliances in 2026 to go up between 5 and 20% on average?
It depends on the appliance, but that's what we are targeting, yes.
Yeah, we can actually adjust the price monthly. We usually give a distributor like a 30-day notification. So some of them already see we probably will increase the price next month. But on the other side, we do have a buffer. That's where we feel we can kind of react this kind of situation better than other competitors. And we also have a good a global operation with own operation center. We manufacture directly.
Okay. And I guess I just want to ask maybe just a question zooming out. I mean, we've seen your peers really accelerate the pace of M&A. You saw that at your kind of endpoint peer, you saw that at your firewall peer, both for tuck-ins and for larger deals. Fortinet hasn't done that over the last few quarters.
And years. That's not their philosophy.
What's your thinking in terms of M&A philosophy and whether, how we should think about that into 2026, whether they're tuck-in deals are needed in certain areas? Thank you.
No offense, but you can spot analysts that have been following Fortinet for a while and analysts that are quite new with the company.
I think the technology we developed, whether the FortiOS, FortiASIC, and integrate all these functions together, sometimes probably more using internal innovation will be better. But we do open for merger acquisition, and also we do look in different opportunities, especially in the secure operation area. But on the other side, we have a discipline, whether the rule of 45 or some healthy margin, and also we try to plan the integration before the acquisition. I think with the multiple, the market a little bit more reasonable now, I think that definitely there's a more opportunity. We will look at the merger acquisition, but we do have the discipline, which we maintained the last 25 years, kind of tend to acquire the technology or some talent instead of try to buy some market or customer base.
The management is very clear. I mean, for years they've been telling us 99% of acquisitions don't work. We don't want to take this risk. You have execution risk, synergies that never happen, a lot of hopes and a lot of disappointments. So we don't want to take those risks, and we want to build in-house. So we are not a fan of acquisitions. The management has been very clear for years and years and years. This is their philosophy.
Crystal clear. Thank you so much, Ken.
Thank you.
Our next question comes from Adam Borg at Stifel. Adam, your line is open. You may unmute and ask your question.
Excellent, and thanks so much for taking the question. Maybe just thinking about your ASIC chips. I don't want to front run anything from Accelerate, but we've been talking about the opportunity for ASIC chips this year, and just remind us, what kind of opportunity there is when those chips come out. How long after an announcement do you typically see those being adopted by customers? Obviously, it goes into test first and ultimately production. But any color there in terms of that and the ability to drive innovation and additional attach going forward. Thanks.
We say the new ASIC chip will come out this year, but we tend to announce together with the product. But also, usually the new ASIC chip also takes some time and to build into the product. That's where the next month's Accelerate is more focused on the FortiOS first, and the ASIC we try not get excited too early, put it this way. But definitely it's a good technology. We're improving the performance. We add more function there. But we usually announce the product after we deliver instead of some competitor try to announce ahead of the time. So that's what we want to keep in the same way, same culture. Once we have the related product, or we are very sure we can deliver to the customer partner, then we announce it.
That's incredibly helpful. And maybe just as a quick follow-up, as a clarifying question, when we talk about the refresh opportunity, be it COVID or otherwise, when those boxes typically come up, and I'm sure the answer is it depends, but do you typically see like a one-for-one box refresh where they come back and buy more boxes? And I guess the follow-up to that would be, what is the kind of the sales motion about cross-selling and upselling SASE and SecOps as part of those refreshes? Thanks so much.
We do see there's a more kind of a what do we call attack surface, or there's a more area you can deploy the network security, and also the convergence also starting kind of take more effect. So now that we see a lot of network security deployed inside the company, do the segmentation, replacing some traditional network gear. Even our own kind of demand for FortiSwitch, FortiAP, which has a FortiLink technology, can link to FortiGate as more like a hardware agent as a SASE. Also see pretty big growth. On the other side, there's like OT security. There's some others whether can supporting work from home. Eventually, the network security can expand into the consumer space. That also could be the new opportunity. But I say, if you look at this, probably depend on the vertical. Also, maybe depend on certain region how mature the network security is. I have to say by vertical, like 5 years ago, the first strong growth come from some retail, right? So whether retail or some other online service. So that part we do see they heavily use in the box, and then this kind of whether 3 to 1, like have a network security, and also the SASE kind of into the same box. We are probably the only one can solve that issue. So we do see that will be continue the market for us basically. On the other side, there's a lot of whether it's in the data center with some other kind of bigger infrastructure. That's probably the new ASIC chip or some other solution we will have, like a FortiAI or some others. Maybe will help.
They did not say anything about the capex, by the way. Their own data centers and their projects for more infrastructure.
But it's dependent. I do see that the market get definitely more broader, bigger. And because there's a more attack service to cover and also more function needed, both inside enterprise and also in the consumer and also in different regions.
And to your other point, we do see any refresh opportunity as an opportunity to expand. And when you look back 5 or 6 years, we didn't have a lot of the solutions that we have right now that are at the maturity level that they're at right now. So, anytime we can have those conversations, whether through our partners or through our sales force, it's an opportunity for us to expand, to not only sell the firewall, but to sell beyond the firewall.
And I would say any of the discussions on with regards to firewall upgrades at the edge is combined with the FortiSASE discussion, because it's so compelling for our customers to expand.
Our last question.
She was not pessimistic during the call, and she was not cautious during the call. Maybe the tone has changed.
It comes from Brian Essex at JP Morgan. Brian, your line is open. You may unmute and ask your question.
Great. Thank you very much for taking the question, and congrats on some solid product growth this quarter. I guess I wanted to just maybe one question with regard to memory questions that were asked previously. Ken, just really I appreciate the fact that you have 6 months of inventory supply. Could you help us understand the dynamics there? Maybe what percentage of your bill of materials is exposed to memory? And then how your contractor agreements, how long do you have those committed out? Just to understand it as we see like the acceleration in prices here. Just want maybe a little more clarity in terms of how you manage your supply chain.
Good question.
I think we are very similar to any other system server. Tend to be 10 to 20% cost come from the memory. Because we also manage a lot of manufactured component directly with the supplier instead of go through some third party.
Okay, so 10-20% of the costs are due to the memory prices. So if memory prices are tripling, it will have a certain impact, but it will not kill the margins. So to offset this, they are increasing their prices for some of their products. Makes sense.
That's where we tend to have some direct contract. That's also dependent on lead time. I think this time probably a little bit different than 5 years ago. 5 years ago, you see that there's a communication chip, there's some CPU, there's a lot of this time probably more related to memory. Actually, you can track the memory. There's a daily memory price tracker actually. You can see somehow the last couple of days since started coming down. So it's kind of interesting. But for us, like I said, we do maintain 6 months inventory. And also based on the growth, based on the projection, sometimes we also kind of up and down, and also depend on the product. So we feel this is the opportunity, just like how we did it 5 years ago. It's the opportunity for us to gain market share, and also we well prepared for that.
Okay.
Right, super helpful. Maybe a quick follow-up for Cristiano. On the security networking side, how much of that was networking, like switches and access points versus more firewall mix? Just kind of curious to get the mix there and how that might influence what you're thinking in terms of software services acceleration in the back half of the year.
So it was a broad-based mix across, so pretty much similar growth rates across all components. So we had good firewall growth as well as APs and switches.
Also, the reason they buy the switch and AP is because we have this we call FortiLink technology. They link all the switch and AP to the FortiGate, and then using FortiGate to process certain traffic. Like if Wi-Fi, they identify there's a visitor, that traffic probably goes to the FortiGate. It's more like a kind of a local SASE approach with the hardware agent, which is AP with the hardware agent. The same thing for the switch. That's actually go a lot of for the internal segmentation. So to kind of broaden security inside the local area networking, that's where the convergence we see happening. But I think the on the percentage, definitely the FortiGate is the key part. It's all leading by the FortiGate. The other part is pretty small, I would say.
All right, really helpful color, Ken. Thank you so much.
Closing remarks.
I'd like to thank everyone for joining today's call. We will be attending investor conferences hosted by Bernstein and Morgan Stanley during the first quarter.
Good.
The Fireside Chat website links will be posted on the events and presentation section of our investor relations website. If you have any follow-up questions, please feel free to contact me and have a great rest of your day.
Good. So we will have more conferences in the following months, in the next month or maybe in 2 months. You always have additional information. So all in all, a pretty good report. They announced more buybacks. The guidance, in my opinion, is too low. The business is reaccelerating. They are suffering from cost pressures from memory prices, and they are using their pricing power to offset these margins, these margin pressures. So actually, the earnings per share does not look appealing because of several reasons: the tax rate, the cash management, the margins. But the thesis is still intact. And if you believe cybersecurity is here to stay, Fortinet is maybe the best opportunity I see in the market. So I'm quite happy with the report. I will let you know if I buy more in the few days, but I'm very happy to be a shareholder of this company, very proud and looking forward to the future. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.